Okay, everybody, we're going to get started. As I said last week, this week we're going to do something a little bit different. And so with that, I welcome David Becker, who heads up our risk solutions business here at Fast Markets, to join us. He is going to give you a little bit of well, first I'm going to give you a little presentation that kind of sets the table for his presentation. Mine is going to put some charts to some of the stuff that we've been talking about over the past couple of months and the potential upside price risk for soybean oil this summer. Again, I think that some of the stuff that I'm about to show you and in my general thoughts are the kinds of prices that I'm going to be talking about today are generally, this is kind of low probability events, but as you'll see from the presentation, things are kind of lining up to potentially take soybean and soybean oil prices much higher than we've seen historically. And then David is going to go through his presentation about some tools that we have that can help you mitigate some of that risk, even if it's not even if your risk is not one that matches up well with the futures market. So if you buy choice white grease, historically, you probably have hedged that risk to the extent that you hedge it with soybean oil or with corn futures. And we have a solution that is a little bit more direct in terms of the correlation. All right, with that, I kind of will get started. And this will be pretty short. Hopefully, I'm going to try and get through this all pretty quickly. So I start with the U.S. drought monitor. As you can see, about half of the country is in drought, and probably more importantly, it's been sort of a multi-year drought. That's important because it makes it more difficult. It's more difficult for thunderstorms to develop over dry ground, because at least a portion of the moisture that's required to produce rain comes from evaporation in the ground. And so if you have disturbances that pass over drier ground, there's a smaller chance that they'll turn into thunderstorms than if they're passing over wet ground. If the drought expands just a little bit eastward, then we get into some of the big soybean producing areas of the country. Now, Nebraska and Iowa are typically two of the largest states, and you can see Nebraska is already in this drought, but a lot of Nebraska farm ground is irrigated because summer tends to be a little bit drier in portions of Nebraska. So the impact there is a little bit less than if we move into Iowa. If the drought expands into Iowa, then we're really getting into one of the largest soybeans producing states in the country. And as I'll show you, it's not going to take much of a decrease in yields this year to have a relatively large impact on prices. All right, so with that, what are the chances that that drought does expand? And I'm going to start with some very basic meteorology. Probably most of you already understand this, but it's kind of important for this discussion. There's a jet stream, and the jet stream generally guides where you see the path of thunderstorms during the summer. So typically a disturbance comes in over the Pacific, rides up over the top of wherever the jet stream sort of crests, and then falls down along the eastern edge of the jet stream. And where that disturbance runs into warm, unsettled air, it starts to produce rainfall. And so the positioning of the jet stream is relatively important to where rain is going to fall throughout the summer. This is the typical pattern, and this is why the Corn Belt is where it is because you can see that in this situation, the storms ride up over the crest of the jet stream, and then they follow it down right into the heart of the Corn Belt, and that's why we produce crops essentially where we produce crops. Now, the jet stream can shift, and there are some big patterns called teleconnections that tend to have an impact on where the jet stream sits and where thunderstorms develop. long-term predictions for this summer suggest that there is a chance that the jet stream, the eastern edge of the jet stream, will shift further east than it typically does. And so that's how we get the drought to expand into Iowa. It is worth noting that projections for the next couple of months suggest regular to above average rainfall across a lot of the Corn Belt. And so it's not like we are saying that we're not going to get any rain between now and in the end of the growing season. In fact, we think we probably will get sufficient rain to get the crop in the ground, but it's really more about what happens in June, July, August, and September. And that's kind of what we're going to try and talk a little bit about today. So this is NOAA's seasonal temperature outlook released at the middle of the month. You can see based on their models that they expect above average temperatures for most of the country and well above average temperatures again over the center of where the drought in the western US is located. And again, if you get a little bit further eastward shift in that downward in the downward slope of the jet stream, you expand that above average temperature area to the east, and that's how we potentially get bad temperatures, at least for some of the big growing areas for oil seeds. And this is NOAA's spring precip outlook for June, July, and August, or this is their seasonal precipitation outlook for June, July, and August. You can see again below average precip expected during those critical months for the Western Corn Belt, and maybe more importantly for the northern US plains and Canadian prairies. If we have another year of drought in those areas, we're going to suffer another short canola crop, and that can only add to the upside price risk on soybeans and other oil seeds and vegetable oils, even if the drought doesn't really move substantially into Iowa. But right now, what NOAA is saying is that they expect hot and dry weather for at least a portion of the Western Corn Belt. There's another chart that I didn't throw in here that kind of shows what NOAA expects the drought to do through the spring. And interestingly, they don't really expect it to they expect it to move a little bit into Iowa, but there were some other areas again where you could see average to above average rainfall in Iowa, and so the drought would actually improve in that area during the spring, during planting time. But they also expected the drought to get worse or drier than normal and probably hotter than normal weather in the Mississippi Delta. And that's important because those are some of the earliest soybeans that are planted and harvested. And so if they're going to start off the year dry and then we have a dry summer, that could be another area where we lose enough yield to have a significant impact on the price outlook. All right, so what does all of this mean? On Thursday, tomorrow, USDA is going to release their prospective plantings report, and market expectations for soybean acreage range from about 86 million acres to about 93 million acres. Yields over the past 10 years have ranged from about 40 to just above 50 bushels per acre. I would say the trend line yield right now is somewhere above 50 bushels an acre. So 50, 51, something like that. This chart is skewed a little bit to the downside because I want to make this point. But what this chart shows is if you get this much acreage and this yield based on our assumptions for demand, this is what soybean ending stocks relative to usage will end up being. And it might be a little bit tough to see, but there's a black outline here that covers a big chunk of this table that suggests that if we get that combination or those combinations of acreage and yields that we're going to need to ration demand based on what we're projecting for demand right now. And as we've talked about a little bit about before, if we need to ration demand, it really comes down to the Chinese buyers against the US biofuel industry, both of which have relatively low elasticities of demand, meaning that they can and may be willing to pay up more to secure supplies of soybeans than they have in the past. China primarily because they're very focused on food security, and the US biofuel industry because of the RFS mandates. Now, of course, there's some risk to the RFS mandates, and those could change, or the administration could do something to provide some relief on those. But if we just kind of assume that things are going to go through or go forward as close to where they are today as possible, this is kind of the area where you start to get into trouble. Basically, if you don't get at least 88 million acres of soybeans and a yield of 50 bushels per acre, it looks like you start to need to ration demand. So what does that look like? This is sort of a long-term chart that shows the average price for the November soybean contract in October, and the range over the past several years, and then a trend line that kind of shows, using stocks to usage, what does that imply for prices. And one of the things that I'd like to point out beyond, this is where our forecast is. You can see our 21-22 forecast for this year, which looks really high relative to where the trend line is. But that's in part because you can see there are other years where we've had sort of multi-year runs of high prices, 10, 11, 11, 12, 12, 13. The second year of those kind of runs tend to produce the highest prices, because as you develop the shortage, prices initially react, and then if the shortage continues or stocks to usage remains relatively low, the market needs to move higher to encourage additional production in the next marketing year, and then they start to come down the next marketing year as farmers respond to the market signals. We're in the second year of relatively tight stocks to usage, so we would expect that this is the year that prices are high. You add into that the what's going on in Ukraine and the general bullish fundamentals for the world market, and you can see that if we really get tight, that soybean prices could move significantly higher. The other thing that I would note is October in November, the fall, is typically when soybean prices are at their lowest, because we are harvesting or have harvested the crop, and so there's lots of supply around. I would expect really that the peak in prices, unless we really do get a drought that requires a lot of demand rationalization, I would expect the peak in prices to be sometime in June or July. All right, and then the final slide. So what does this mean for soybean oil prices? This is the correlation between soybean prices and soybean oil prices. It's a really simple way to look at it. Obviously, at $16 soybeans, you can see that that implies 60 cents per pound soybean oil. But the other thing that I want you to note is that if you look over the past year or so, the prices have been trending well above the trend line because of the expectation for the increase in renewable demand and the impact that that's going to have on soybean oil stocks. Right now, we're getting prices that are well above the trend line, and we still have more than 2 billion pounds of soybean stocks in any given month. So we haven't really hit a spot where soybean oil stocks are tight and we have high soybean prices. If we get into this situation where we need to ration soybean demand and prices go to well above where they have been historically, $18, $20, something like that, I think it's very easy again to say that if you sort of extend this chart out, that you could get into the 90-cent range for soybean oil futures, 80 cents, 90 cents pretty easily. And then if you add another 18 to 20 cents on top of that for RBD soybean oil relative to the futures markets, you're at $1 per pound for RBD. And that's kind of, again, like I said at the beginning, that's not our base case. That's not what we're forecasting. But I do think that this is a year that is possible. Everything would need to fall right into place in order for that to happen. But most years I would never give a talk like this. This year I am, because I think it's important, and I think that end users and producers need to be prepared for the potential price volatility that we're going to see this summer. Okay, with that, I will stop sharing my screen and I will turn it over to David, who will give us some insights in how to deal with the potential increase in prices.
Thanks, Tori. Let me see. There you go. Hello, everybody. Tori, thanks so much for giving me the opportunity to speak to everybody. I'm going to try to share my screen. Hopefully everybody can see it. Share.
Perfect.
Excellent. All right, so my role at Fastmarkets is the Director of Risk Solutions. I came over when the Jacobson was purchased by Fastmarkets. I was working with the Jacobson since 2012. Prior to that, I spent about 25 years at 2 different investment banks and 3 different hedge funds, doing a combination of portfolio management and market making in commodities, fixed income, foreign exchange, and in the equity markets as well. So my background is in risk and managing risk on both the trading side as well as the derivative side. My role is to help the clients of Fastmarkets understand the different risks that they have, since almost everybody who is a client is looking at the different prices that are managed through that we actually show, and the forecasts that we actually show. There we go. So what do we offer? You can read, but in general, risk solutions help determine an efficient way to mitigate as well as enhance any of the risks that are associated with commodity price movements. We have several different tools that I'll talk about later that can describe the inherent risks in your business operations. And then really any producer, end user, refiner, crusher, smelter, ingredient purchaser, trader, broker, financial or physical commodity person would benefit from looking at these different things. When I talk about them, the first thing that people want to understand is, well, give me an example. Let me see what you're talking about. And you guys were talking about RBD soybean oil. And what you've seen from the more recent movements in the price action of RBD soybean oil, and this is the Jacobson, Illinois basis location to the CME futures. That market has broken down. The correlation between RBD soybean oil, the Jacobson, from 2003 to 2019 was 92%. So 92% of the time you could determine the direction of RBD soybean oil from CME soybean oil and vice versa. And in the last, I would say 14, 15 months, the correlation between the two is about 71%. So the correlation has broken down. And so because that correlation is broken down, a refiner who might purchase beans, who is selling CME soybean oil to hedge their exposure to soybean oil once it's processed and then refined, only can really lock in their profits, given the breakdown in RBD and soybean oil, once there's a physical sale. So once they actually have a physical sale of their RBD soybean oil, assuming that that's what they actually sell at the end of their line, they would then lift their soybean oil futures hedge and lock in the profits that they have. But in the interim, they're exposed to the difference between RBD soybean oil and CME soybean oil. And the same can be said for the end user, somebody who is going to buy that RBD soybean oil, but uses the CME futures contract for it and purchases the CME futures contract as a way to lock in their exposure to soybean oil prices, is exposed to the movements in the basis between RBD soybean oil and CME soybean oil, and either or could have a mark-to-market gain or loss until there's actually a physical sale. And so with that in mind, there is the need for potentially a financial player to step in and create either a swap or an option on the difference between RBD soybean oil, the Jacobson, say the Illinois basis location, and the CME. And if you have that particular swap, which is maybe just a fixed price swap, which allows you to fix the difference between CME soybean oil and RBD soybean oil, or just fix the price of your RBD soybean oil, you would have a better gauge if that was your exposure than the CME as a gauge, which is mainly crude oil. Right, so in the tool chest, so what are the kind of things that I can offer to different people? I mean, if you look across the board, if you have exposure to the prices that are available in fast markets, you can run large correlation matrices between all the prices that you have, look at the historical volatility, forecast future volatility using things like Garch. In terms of hedging, we can help with both over-the-counter hedging as well as exchange traded hedging, different products like swaps, options, option spreads. So those are like call spreads, put spreads, calendar spreads, risk reversals where you're selling a call and buying a put, or buying a call and selling a put. A swaption is it's a swap that's into an option. So you have the right to buy a swap. Spread options, in the case that we were just talking about with RBD soybean oil and CME soybean oil, if you are a refiner and generally you sell CME soybean oil as a way to hedge your future exposure, you might consider selling an option on the spread between RBD soybean oil and CME soybean oil. So that's a spread option. They have those on the floor for like the heat crack or the gasoline crack in the refining space, or the crushes on the CME as well. Very similar type of option where you have an option on a spread. Obviously, futures contracts, options on futures contracts, and options on future spreads, which is some of the things that I just mentioned. Oops. All right. Additionally, I can some of the things that we're going to offer is probability analysis. So it's a modeling of like what happens to your portfolio if prices move X amount, and modeling those scenarios to be able to give you sort of an efficient portfolio. We can run value at risk analysis on your current portfolio of prices that are exposed to fast market prices, as well as potential exposure. We can do value at risk of your exposure with hedges. So you can say, this is what I have right now, and what if I put in these hedges, what is it going to be like? In the world of hedge fund and trading company and banks, at the very highest level, they like to use value at risk. It's not a perfect way to see your actual exposure, your actual delta exposure to the markets moving. But from a very high level, it's a good way to say, what happens if there's an X standard deviation move? It can help with credit considerations, futures clearing and margining, as well as any ISDA type of language or, information that you might need. The ISDA is the over-the-counter negotiated language that are just generally used between counterparts who are doing over-the-counter transactions. So that's just like a general idea of the different things that we'll use in as part of the risk solutions business. So I have this picture. It's relatively old. I showed this picture when I did managing price risk without futures market. And what's interesting about it is the fact that understanding what you want to use to hedge your exposure is an important part of risk management. And so, if you have exposure to tallow or yellow grease and you use the soybean oil futures contract, you might be using something that does not really move in tandem with the returns of the product that you have. And here is an example of a rolling 12-week correlation of bleachable fancy tallow and CME soybean oil. And so rolling means that the correlation, the correlation coefficient, how you check to see if something moves in tandem with one another, changes every 12 weeks. So you're looking back 12 weeks to determine the difference in the correlation. And as you can see, it pops around, but the average over the course of the 10-year period that was looked at was basically zero. And so that's saying that if you're using bleachable fancy, soybean oil to hedge your bleachable fancy tallow exposure, you are using an instrument that doesn't really move in tandem with your exposure. And these are the kind of things that we can do with all the different products that are priced on fast markets. All right, and so one of the most important things, and something that I work on, and it will be helpful to, all the clients that are looking for risk solutions, is who can help me with it in a market making sense. If you were going to do crude oil swaps and you are like a crude oil producer, there are a bounty of different banks and trading companies that would either write you swaps, or you can go to the floor and do hedges on the floor. In the world of fast markets, we currently have a few interested parties. One is called Stable, and they will do FATs, and they will write options on the different fat products that we have on the Jacobson. So that includes tallow, yellow grease, poultry fat, distillers corn oil, UCO. They'll also do sunflower oil, as well as coconut oil. And they generally try to stay away from the instruments that have very high correlation to what's available on the exchanges. So Stable is a sort of a partner of ours. We're happy to do introductions to help you if you have who are interested in managing any of those price risks. Additionally, there are at least 2 investment banks now that are looking to partner with some of the different clients that we have who are interested in potentially swaps or options on some of the different products that we have. Any of those introductions would go through me as well too. And this is my phone number. And I want to again thank Tori for allowing me to speak. I'm happy to answer questions as well too.
Oh, thanks, David. Really appreciate you coming to help us today. And if anybody does have any questions, you can do it the usual way. You can type them in the Q&A or in the chat, and we can get to those. Otherwise, feel free to reach out to either David or myself, and I can put you in touch with David, or you can reach straight out to David, and he can kind of take it from there. 2 other things that I will just kind of wrap up with, if it looks like we don't have any questions. One is that we're going to start to do this kind of thing, not always with David, but something a little bit different than we typically do, where I kind of run through some of the charts that we have online. I'm going to start to do a presentation about once a month that gives you a little bit broader context for some of the views that we have based on charts that don't show up on the website. And the other thing is that it got a little tied up yesterday, and so today's report has not been published yet. It will be published before the end of the day, so I apologize if that causes anybody any problems. I'm getting on it as quickly as I can, and only have a couple more articles to go. So it should be out in the next couple of hours, but certainly it will be out by the end of the day. All right, if nobody has any questions, then I will see you all next week and we will talk about fats and oils. Thanks, everybody. Have a great day and thanks for attending. And thanks again, David.